The success of a real estate investment often comes down to location, and the market you choose to invest in can make or break your deal. And picking the next Phoenix, Austin, or Boise is really hard to do, but there are a few things that you can do to stack the odds in your favor when choosing where you want to invest and the places that you plan to park your capital for the next 5, 7, 10 years or more. So to help you with the process of finding the next hot market, regardless of where you live, in this video, let's walk through the key components of a real estate market analysis and the things that matter most when deciding where to invest. So when the big name institutional investment firms are deciding whether or not they want to enter a market, these companies are usually going to focus on three main things. And the first thing on this list that you will also want to look at when deciding whether or not to target a certain metro is the demographic profile of the market that you're analyzing. Now, there are a lot of different things that make up the demographics of an area, but one of the most important components for real estate investors is the net migration within the market, which reflects the net number of people who move into and out of an area during a specified period of time. Net migration figures can be some of the most important metrics to track when analyzing a market, since these will tell you directly how the population is changing and whether that's shifting in a positive or negative direction. And as far as the things that impact net migration in an area, job growth is one of the biggest metrics that ends up affecting net migration patterns, since even with the rise of remote work, people still tend to move where the jobs are. Cities like Austin, Miami, and Phoenix are prime examples of this, with huge job growth numbers posted in each of these markets over the past few years, which has led to a ton of real estate rent and value growth, with demand outpacing supply in a really big way. Employment concentration is also something investors are going to take a hard look at when analyzing a geographic market, especially if that market is reliant upon the success of just one or two specific industries or even one or two specific companies that could tank real estate rents and values if these industries or companies were to contract or even disappear. And employment not only brings people into an area, but also impacts how much those people spend within a market, which makes income statistics another metric that is heavily scrutinized by investors, specifically those focused on consumer-facing product types. For example, the success of retail properties is directly tied to consumer spending, which is directly impacted by incomes and changes in incomes over time. And for multifamily properties, incomes directly impact how much an individual or family can pay to rent a unit, directly affecting the overall revenue that property owners are able to generate. Ultimately, investors are looking for markets that show strong net migration patterns, strong job growth, a diverse employment base, and an upward trajectory in incomes that can support B2C property types and general economic growth within the area. Now, aside from overall demographics, investors are also going to be looking at the effect of those demographics on real estate metrics directly, and they're going to do that by next taking a look at the supply and demand dynamics that are present in the market. On the supply side of things, investors are most closely going to be looking at the current construction pipeline, since this represents the total square footage or number of units that are projected to come online within the next 1 to 3 years. And the construction pipeline is usually broken down into 4 different categories, including proposed projects, planned projects, projects under construction, and newly built properties that are currently in lease up, each of which can give an investor a general sense of how much new product is going to be delivered into the market in the near term and whether or not demand is going to keep up. And on the demand side of things, investors are usually going to be focused on 3 main metrics, and these are going to be the current vacancy levels in the market, net absorption in the market, and both historical and projected rent growth figures. And the current vacancy within the market is important because this metric is going to tell an investor the percentage of leasable area in the market that is not currently occupied, which can provide a really helpful snapshot of the supply and demand balance or imbalance at the current moment in time. However, when trying to underwrite projected property performance into the future, net absorption figures will often tell an even clearer story about where the market is headed and what vacancy statistics might look like over the next few years. And if you're not familiar with the term net absorption, this number represents the total square footage or number of units in the market that became physically occupied in a given period minus the total square footage or number of units that became physically vacant in that same period, with strong positive net absorption serving as an indicator that demand is outpacing supply. And ultimately, the rate at which demand outpaces supply directly impacts rent growth in the area, which has a huge effect on how investors value deals and the profitability of a potential acquisition or development play within the immediate area. Overall, when looking at supply and demand dynamics, investors are generally going to be looking for markets with limited new competing supply, tight vacancy rates, strong net absorption figures, and rent growth projections that meet or exceed actual historical values. Now, once an investor has a solid grip on the demographics of the area and the current and future supply and demand fundamentals in the metro, the last step in analyzing a market is getting a sense for the current state of the capital markets, specifically total investment sales figures and major lease or sale transactions that can tell an investor more about tenant and investor interest within the market today. On the investment sales side, strong investment volume usually means a larger buyer pool when you go to sell the deal, and likely a more competitive bidding process, which can push pricing a lot at the time you're ready to exit. And as far as notable transactions are concerned, the biggest deals are often done by the biggest players in the industry, which can leave clues as to what future investment volume might look like and other investment firms or tenants that might enter the market over the near term. So for example, if you're analyzing a deal in a secondary market and you find out Blackstone just bought a $100 million property right down the street, you can bet that they've spent a significant amount of time and resources building that investment thesis, but also that many other major institutions are probably seeing the same things, and they will likely follow suit, again increasing demand in the market and increasing your exit optionality when you ultimately sell the deal. And on the leasing side of things, if you're analyzing a deal in a secondary market and Google signs an office lease right down the street, this could have huge implications for demand in the market from other major office tenants, but also for residential housing for these employees, retail stores that these employees will shop at, and industrial warehouse space that will be necessary to get products ordered online to these people more quickly. Overall, these are the things that investors are going to be looking for when trying to find that next hot market, and the stats that are often included in investment committee presentations and equity memos to paint the picture around why the location of the deal makes sense and how that location is going to help boost property returns over time. And if you want to learn more about how to underwrite and value commercial real estate properties, or you just want some pre-built templates to help you analyze deals more efficiently, as always, make sure to check out our all-in-one membership trading platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, and retail deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on real estate investment analysis, make sure to hit the like button and let me know. And let me know in the comments any other data that you look for when making a yes or no decision on a market. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.